Welcome to today's session and thanks for joining. In these videos, I show how you can swing trade profitably in any market condition, up, down or sideways, by taking only high probability and low risk trades that have maximum forces from the market, sector industry, fundamental, technical and even seasonality in their favor. I will revisit some trade ideas or market analysis I shared recently and review how that played out. If you stay with me, I will show some stocks getting ready to buy or short, or maybe that you could buy last week. If we have time, we may look at some trades that you may trade next week, but I will do that based on my preferred trading direction. We'll discover that during this session. A perfect setup or a bigger profit, which one would you prefer? The answer may differentiate a novice trader from a mature one. I interact with many traders and those interactions tend to show who is a novice and who is a mature trader. Are they different people? No. They are the same people at different points in time. Every mature trader was a novice trader at one point. It is a natural path of development. We all have been novice traders at some point. In some way or another, probably we all are still novice traders. I know that I am. Why do I discuss this today? Last week I shared two trading ideas. One made a large profit and a partial profit could already be booked. The other made a loss but stop is not yet triggered. People came to see these two trades. There was no comment on the losing trade which has not yet triggered a stop. The profitable trade had different comments from different traders. One trader looked at the profitable trade result. Last week, the stock went up by 20% and commented in our Zoom call, that was a great trade. Another trader looked at the same trade and emailed me soon after I posted it on the Traders Club. He asked, why did you take that trade in the first place? Both comments were appropriate in some way. However, it made me reflect upon it during my spare time, of which I have plenty in hand. In earlier trading days, I got easily enamored by the profit. Over time, I focused more on consistency than the amount of profit. And the consistency in results came from consistency in approach. Of the two trades I shared, the losing trade was a 360 degrees Q setup. The hugely profitable trade was based on Q signals but not a perfect trade setup. Such trades are better left to people using Q for a while. Which one would you prefer? After knowing the results, we would prefer the profitable one. But we never know the outcome when we place a trade. With that in mind, a mature trader focuses on the analysis, not the outcome. Going by that, the losing trade was the better trade. You may notice that the first trade I shared was a bearish trade. That was the losing trade, which was in line. The bearish trade, being bearish, was in line with my preferred trading direction in the previous market recap. My market view changed during the week and the second trade was bullish. That was the profitable trade. However, taken together, they represent my secret of success in trading. Observe the market and follow it. Remain flexible. Here is my approach to swing trading profitably. Manage risk by sizing properly and do not worry about the outcome. Large profits do not matter much. Small losses do not matter at all. Large losses matter, which I try to avoid. Use robust analysis to decide trades and keep trading. If you are not making a reasonable profit, use the Q diary to fine tune and try again. As I always say, there is no reason not to trade profitably. Greetings. I am Sagar Nandi, retired IT professional, swing trading stocks in the USA and India markets using only one trading system that I developed myself. You may contact me using my email ID info@superiorprofit.co or tradingprofitably@gmail.com. I regularly share live stock and market analysis on my website superiorprofit.co, X handle Superior Profit, and YouTube channel Trading Profitably. All these are open to the public and you are most welcome to make use of them. Disclaimer: this demonstration is for educational purposes only. I am not an investment advisor. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. Options trading can be risky. You may refer to the characteristics and risks of standardized options document from OCC to decide if options trading is suitable for you. Q runs on Metastock and TradeStation platforms. It has multiple components and I'll use several of them in today's session. Let's start with dollar index. Dollar index is very bullish. In the weekly, it broke above the watermark resistance that happened 1 week ago. This week it moved up further, closed with a bullish color but somewhat indecisive candle, but still very bullish move. In the daily, it is at price extreme high with jump thrust high. Such an up move is usually unsustainable, but it has no bearish signal at present. First of all, this trend line support has to be broken to show any resemblance of weakness in dollar index. So long as dollar index is so strong, it may put pressure on the stock market, which does not seem to happen recently, isn't it? Dollar index as well as market both are going up. But internally the market may not be so strong. Whether that is true or not, we'll discover it in today's session. Other than dollar index, another index I look at, a custom index, to see how market may be influenced is the mega cap index. Mega cap index has robust trendline support in weekly, close to with a bullish shape, bullish color in weekly. However, in daily, we have several pause signals or cautionary signals. One is the cluster of bearish indecision at the top, and the other one is bearish headwind potential reversal signal. However, again here, unless at least this first trend line support is broken, it is going to remain bullish. And even after the first trend line is broken, there are other trend lines, so it will not turn bearish anytime soon. Still, if the first trend line support is broken, the second one being far away will probably put some pressure on the market. If the first trend line support is broken, you may keep an eye on that. I will too. Market breadth from Q invaluable in assessing the internal health of the market and anticipating a change in market direction. And whether we can anticipate a change in direction or not, we'll find that out today. This is a snapshot I shared last week. Snapshot of market breadth total view, the broadest view of the market. At that time, I pointed to the cluster of warnings in new high, new low percentage plot. Usually after that cluster, price tends to come down. It came down a little bit. And also I pointed to the cluster of confirmed Hindenburg omen. At that time, we had 3 in a row. That was last week's market recap. How did it change today? Let's start from the top. The oscillator percentage of stocks above 50-day moving average. If you look at it, it is not going up, it is not coming down for a long time. What does it mean? That means internally the market is not getting more bearish or bullish from this market internal health check indicator. Market is remaining stagnant. However, the candle plot is going up. That's why if we just look at the candle plot, the external view, it doesn't tell the true story. The true story is market is not moving up, it's not moving down also internally. The other oscillator, 3-month new high low, that is actually very close to being extremely overbought. I started following it after observing Dr. Jeffrey Scott use it, and it has been a very valuable, useful, profitable tool in my arsenal. Whenever I see it is extremely overbought near these two upper threshold lines, I stop buying, and that is what is happening here, at least as far as the total view, the broadest view of the market is concerned. Also, the concern is there from confirmed Hindenburg omens. Last week I showed there were 3 in a row, and now there are 4 more. That is 7 confirmed Hindenburg omens in a row. That has not happened in a very long time. Now there is a difference between the oscillators, percentage of stocks above 50-day moving average, 3-month new high low. These two are oscillators. They are immediately actionable. The Hindenburg omen is not immediately actionable, but it is cautionary enough to make me think twice before buying stocks now. Again, we'll see whether some pocket is not overbought yet, but overall the total view is very close to being extremely overbought. And if I buy at all, if you buy at all, we may buy in the strongest pocket from multiple angles. If we look at growth versus value, it's coming down, so we may avoid growth, prefer value. Small cap versus large cap going up, so we may prefer small cap, avoid large cap. So we may avoid large cap, mega cap growth and prefer small cap value. Earlier, when discussing today's theme, I mentioned the secret of my success as remaining flexible, turning from bearish to bullish or bullish to bearish depending on how the market is moving, and I don't wait for the week to complete to change my preferred trading direction. That is what I mean by remaining flexible. The other flexibility in my trading is to look at the strongest and weakest pockets. I am not stuck with buying only growth stocks, not stuck with buying only value stocks. I am not stuck with buying only small cap or mid cap or large cap. I look at how the market is moving, which pocket is stronger, and if I'm buying, I want to buy in the strongest pocket. Going by that, it seems today's preferred pocket will be small cap value. That is what we can discover from this market breadth total view. Later on, I will show where the Hindenburgs came from, NYSE or NASDAQ, but before that, let's look at the total views at a glance weekly daily chart. If you remember last market recaps video, you would know that I kept on telling that the memory trendline supports will be difficult to break in one go. And the memory trendline support was there not only in the USA Total View Custom Index, it was in many market ETFs also. It was there across the board. And these are very robust support. It is very unlikely that they can be broken in one go. And that came true. For total view, the trendline supports held and it went up again. If you look at the weekly, 1 week ago it displayed a bearish headwind. This week it went up but did not cross the high of previous week's candle. It is an inside candle, but it is a bullish candle in shape and color. Daily it is clearly in an uptrend. I will repeat the comment I made last week. It will not be easy to break all these trend line supports in one go. Therefore, it will be difficult to turn bearish looking at total view, the broadest view of the market. And when you see that the total view's relative performance is going up, you know that mega caps are not doing well, relatively speaking. Mega cap, large caps, they are not doing relatively well. That's why the total view is doing better than the market. Now let's see where the Hindenburgs came from. Nasdaq on the left, NYSE on the right, and we see a cluster of confirmed Hindenburg omens in both Nasdaq and NYSE. If we look at percentage of stocks above 50-day moving average, again, it is non-directional in both Nasdaq and NYSE, though the candle charts are going up. Internally, it is telling us that the market is not so strong as is shown by the candle charts. If we look at the 3-month new high low, last week in the market recap I mentioned that Nasdaq was close to being extremely oversold. As I mentioned, this works like a clockwork. Thanks to Dr. Jeffrey, I follow it regularly. It started to go up this week, and that's when I changed my preferred trading direction from bearish to bullish, and I shared a bullish trading idea during the week on my website. The 3-month new high low tilting up in Nasdaq was one of the factors that helped me change my preferred trading direction. 3-month new high low in NYSE was not close to being oversold. So NYSE was stronger, and we see that now Nasdaq is not close to being overbought, but NYSE is. Also, NYSE has shown this cluster of alerts, new high, new low percentage alerts. So taken together, the Hindenburgs, the 3-month new high low in NYSE being extremely overbought, and the new high, new low percentage alert in NYSE, and the fact that percentage of stocks above 50-day moving average is not showing the bullishness as we see in the external view, I am not keen to buy many stocks now. That is still at the market level. We'll see if some pocket is stronger than others. Let's look at the major indexes to find that out. Dow Jones Industrials, and I will repeat some of the patterns appearing in the major indexes, and you will see why I may not be willing to buy now. Percentage of stocks above 50-day moving average, it is actually coming down, the yellow line in Dow Jones Industrials, whereas the candle chart itself is going up. That is showing a bearish divergence that may not be ignored. Also, 3-month new high low is already hitting extreme upper threshold. Nasdaq 100, like a broken record, percentage of stocks above 50-day moving average is actually coming down while the candle chart is going up, showing bearish divergence. 3-month new high low is at extremely overbought area. Russell 2000. Here the picture is different. Percentage of stocks above 50-day moving average does not have bearish divergence. It is going up while the candle chart is going up, and the 3-month new high low is near to being overbought but not there yet. So this is what I meant by finding the strongest pocket. Small cap is the strongest pocket. We saw that from total view also. Small cap is outperforming, and now we see it is not overbought yet. We see that it is not showing a bearish divergence from percentage of stocks above 50-day moving average. So if I want to buy some stock today, going by the analysis we saw so far, I would go for small cap value. That decision is unambiguous. What about S&P 1500? Again, percentage of stocks above 50-day moving average showing bearish divergence. 3-month new high low is already at the extremely overbought level. And S&P 500, again, percentage of stocks above 50-day moving average showing bearish divergence. 3-month new high low already at extremely overbought level. Other than small cap Russell index, all the other major indexes are not buyable at this point. Only small cap is, and only value stocks are. What is the market's external view? This is a plot using Q performance finder on TradeStation Q Elite, weekly interval for the market ETFs. If we look at 3-week, 2-week and 1-week period, small cap is the strongest. IWM is the strongest. SPY and QQQ are doing worse. One reason is probably because the large cap mega caps are not doing well. SPY and especially QQQ is hugely influenced by mega caps and then large caps. Of course, IWM don't have large caps. That is why I prefer to buy now, if I buy at all, in small caps, avoid large cap mega caps. This week everything went up, but small caps went up by a much bigger percentage. Let's look at the market ETFs. SPY displayed a bearish headwind in weekly 1 week ago. This week it is bullish in color and shape. We have an inside candle, did not cross above the high of previous week. Daily has many trendline supports. I'll repeat the comment I made last week. It will not be easy for SPY to break all these trendline supports in one go. That is unlikely. Dia, bearish headwind 1 week ago. This week it reversed. That's why I started buying during the week. This is one ETF that closed higher than previous week's open. So on a closing basis in the weekly chart, Dia made a new all-time high. It is outperforming the broad market. In daily, it is in an uptrend. Again, has multiple trend line supports. It will not be easy for Dia to break the supports in one go. Doesn't allow shorting. The trend line supports are making it difficult to short. That is true looking at SPY, that is true looking at Dia, that is true looking at Mega Cap Custom Index, that is true looking at Total View Custom Index, and that will be true looking at IWM also. Had a bear release in weekly 1 week ago. This week it went up but did not close above previous week's high. Small cap is outperforming the market. Daily is in an uptrend, has multiple trend line supports. It will not be easy to break those supports in one go. Difficult to short. QQQ. This is the weakest of the market ETFs now. 1 week ago had a bear release. This week it turned bullish, but see the size of this week's candle. Much smaller compared to previous week's bearish candle. Underperforming broad market, but it also has multiple trend line supports. It may not be easy for them to break in one go, but it is still the weakest of the market ETFs, and mega caps have huge impact on QQQ. One of the mega caps that declared earnings last week was Nvidia. Nvidia was darling of many people for good reason. It had a stellar rally. Let's look at Nvidia's chart. In the weekly, we now have a bear release and a bearish indecision and a bearish backdrop color. This week earnings came out and this week's candle shape is anything but bullish. If we look at the activity or volume pattern, the down volume is increasing for 2 weeks now. In the daily, it has completed a false upside breakout at the level where bearish headwind came earlier. It is not uncommon for price to retest the watermark created by bearish headwind, and oftentimes it will create a false upside breakout, and that has happened again in Nvidia. That is not bullish. However, it has multiple trend line supports, but it is not so solidly uptrending as other market ETFs. Therefore, this is more likely to break the trend line supports than the market ETFs, and if it breaks the trend line supports, at least the ones here close to Friday's close, and if it breaks the yellow direction line, that will put additional pressure on QQQ first and probably on the other market ETFs later. During the week, I expressed my conservative view on Nvidia using a 5-minute chart, and if you followed that and used your own analysis based on that, you could profitably short Nvidia using options vertical, that is using a defined risk strategy, and I did that and I made some profit. I have booked some profit and I am holding the options vertical bearish position. There was no swing trade setup using Q setups. In those cases, if I have a bearish view on a stock, I use the intraday charts to enter the trade, as I did in this case. I booked some profit and I am holding the remaining position. Bucket analysis and sector industry stock breadth using Q edge helps to decide preferred trading direction that may be different from current market trend. Current market trend is clearly bullish, but I so far decided not to buy stocks other than in small caps. Let's see what additional insights we can get from Q edge. Friday's market is clearly bullish across the board, sectors, industries, stocks. All the sectors went up by significant percentage. 77% of stocks in QH, that is S&P 1500 stocks, are above mid Bollinger Band, that is bullish, and it is not overbought. Not many stocks are above upper Bollinger Band, not overbought, of course not oversold. It is bullish, cannot be oversold. And if you look at the pairs of bars here in the bucket analysis graph, bar graph, you will see a shift of stocks from lower Bollinger Band to the mid-high level, and also shift from stocks above upper Bollinger Band to the mid-high levels. Meaning stocks that were underperforming earlier, many small caps, they did better, and the ones that were leaders, they actually came down a bit. It is still remaining bullish, but there is a rotation going on. The leaders coming down and the laggards doing relatively better. That is what we can discover from the bucket analysis. Again, that tells us to focus on stocks that were not doing well earlier, some small caps maybe. If we look at the transition from 1 month to 1 day, 1 month is bullish, longer term, then 10-day, also longer term, was bullish but bullishness reduced. 5-day turned bullish again, and 2-day, 1-day are also bullish. It is clearly bullish, it is not overbought, therefore it is difficult to short. Only option is to buy. Technical breadth invaluable in deciding preferred trading direction from breadth charts, and then find unambiguous technical setups for individual stocks. Something interesting is going on. Interesting in my trading jargon means something that I can use to make decisions, objective decisions, unambiguous decisions. 2 weeks ago, this is what I shared in the market recap. Weekly technical breadth. It was very bullish to the point that it was looking overbought. Whenever all the percentages here are at or around or above 80%, that is a sign of being overbought. So 2 weeks ago it was overbought. Last week it completely reversed, became oversold with even headwind alerts. By the way, the headwind alert was effective because stocks that were at a very high price level, they came down. That we saw from the bucket analysis also. The leaders pulled back. So last week the technical breadth weekly was bearish, flip-flopped, and this week turned extremely bullish again to the point of being overbought. Overbought to oversold to overbought. This flip-flop is concerning. If that flip-flop continues, next week may be bearish. However, there is no bearish sign yet. Weakness signs will be visible first in the daily technical breadth. And how is Friday's technical breadth? All setups bullish, strength setups bullish, trend continuation bullish, reversal more bearish than bullish. However, reversals are much smaller in number. The concern comes, though it is bullish overall, no doubt about that, the concern comes from this being overbought, because more than 50%, well above 55, well 50%, 55% of bullish setups are coming from price extreme high. That is showing an overbought condition, and this is in line with what we saw from 3-month new high low, which has hit extreme overbought condition across the board other than in small caps. Whereas if we are looking to short stocks, most of the short setups at price extreme high, those are lucrative shorting opportunities. The market analysis is not letting us short yet, but the moment it allows us to short, and we may find that out, that moment from Q, find the technical breadth daily first when these graphs turn bearish. If we are allowed to short, we will probably find many lucrative shorting opportunities. Now, market is looking overbought from technical breadth point, both daily and weekly. Market level summary, combining all that, small cap buying is allowed. Other pockets are too overbought to chase. Even small cap is close to being overbought, so caution is warranted. Cautionary signs are from Hindenburg cluster, both Nasdaq and NYSE. The bearish divergence of percentage stocks above 50 MA and price. 3-month new high low being extremely overbought in many pockets, in fact all pockets other than small caps, and weekly technical breadth flip-flop. So fewer buying may be wiser even in small caps. Value is preferred. Large cap tech, mega cap tech may be avoided. Look for signs of weakness next week. If that comes, I'll remain flexible. There may be lucrative shorting opportunities. Review of last week's trade ideas. I shared two ideas, one in the last market recap, that was HLIT. That was a short setup and the stock went up, so this was the losing trade. Another was CLVT that I shared on my website in the Traders Club. That was a bullish setup, bullish trade, and the stock went up by 21% plus this week. So overall, of course, I made a profit. I traded both of them. You may, if you forgot the analysis of HLIT or CLVT, you may look them up from last week's video for HLIT and Traders Club for CLVT. Let me review the two stocks charts only now. HLIT. Last week's short trading idea. I shared it based on this day's analysis, that was Friday 1 week ago. It confirmed a flow trend following short setup. I did not take the trade as of Friday's close. I entered it next day using real-time precision entry chart. So my feel was better than Friday's close. So I took the short trade and then the market recovered and the stock also recovered. However, if I look at the protection level, my stop was at this point and the stop was not hit. It was about to be hit on Friday but did not actually hit it. It closed with an upper tail. So I'm hoping that it will come down next week, but if it does not, if it goes up, it will hit the stop and I'll come out. Remember what I mentioned in today's theme, small losses do not matter to overall account profitability. So I'll be more than happy to close the trade with a small loss if the stop is hit. And the bullish trade idea that I shared was CLVT. It was shared in the Traders Club. Traders Club is on the Superior Profit website from the club menu. And I shared there both the technical chart pointed to many of the bullish signals, and also I shared the fundamental analysis. I'll not go through that. You may look at it from there, but let's look at the chart as of today. I shared the bullish idea on this day when at price extreme low, jump thrust low, it gave a big move up 3. That has proven to be a very reliable pattern, and I also noticed the big move up 3 here coming shortly after big move down 3, and it completing a false downside breakout, and it had a bull release signal. It also had a bullish pressure U-turn. So right at that point I bought the stock. It was not a Q trade setup, but the signals on this chart allowed me to buy, and the fundamentals allowed me to buy also. And after that, the stock has gone up by more than 20%. I have already booked at least partial profit in the trade. And now you can see the weekly also has created a false downside breakout. Weekly has very strong bullish momentum as well. Now people may be taking notice, if at all. They may be buying now, but I was alert. I found it earlier using Q Finder as a lucrative buy setup, bought it and booked partial profit. This week's trade ideas. Looking at my preferred trading direction, which is telling me to buy but only in small cap value, and that to be cautious. I am not very keen to share new trading ideas. I do trade many more stocks than I share on my forums, Twitter, etc. So instead of trying to find a trade setup today, let me share a stock I traded last week. It is still at a very low price level, and why I wanted to share this particular stock is because it had two very effective patterns, two patterns that has proven to be very useful. The stock is GIS. Let's look at its fundamentals first. That is General Mills, GIS. Consumer staples, defensive stock. Interestingly, it was a defensive stock, not a high growth stock. It's a dividend paying stock. Profitable company. Earnings per share is positive. Funds are accumulating. Pays a decent dividend yield. Not very high when you look at today's interest rate, but still it has a decent dividend yield. Price is steadily going up. I bought it last week. As of Friday, 68% of PR stocks in packaged foods and meats went up. Let's look at its industry score. It is still nowhere near being the strongest, but it is improving in score, has some acceleration. I bought it during the week. That time the industry score was different. And let's look at its charts. That was a key driver to my decision. GIS. Again, this had the pattern of price extreme low, jump thrust low, came big move up 3, a pattern that has hardly ever failed me, provided it came in a strong fundamental stock. To me, the stock looked attractive enough for me to buy right on this day using this pattern, and the fundamentals looked at industry also at that time, because I found it in real time. My fill price was slightly better, not very much better, slightly better than the close of Friday. My stop was below recent low, and I decided my target accordingly, that is same as the risk distance. I placed my GTC order on Friday. The order was about to be triggered, the profit booking order, but did not quite do it. I think it covered about 90% of the distance, and looking at the overall market being overbought, I decided to book partial profit. So I have already booked partial profit. And why I wanted to discuss this stock specifically today is because it did not have only one of the lucrative patterns, that is big move up 3 at price extreme low, jump thrust low. It had another pattern that I often talk about when I see one, that is a stock at long-term trend line support. And talk about support, there were too many in the weekly, and a short-term trend line breakout. The trend line breakout was there. Now the trend line is not there in the regular chart. If I look at the historical chart, you can see that the trend line breakout was also there. So it had two of the lucrative patterns, big move up 3 at jump thrust low, price extreme low, and a short-term trend line breakout while having a long-term trend line support. When you have two of the most lucrative patterns in the technical charts, then you may be able to buy it more confidently. So what do I mean by that, more confidently? I size my position. Usually I keep same risk in all the swing trades, but in this case, looking at the cluster of patterns in favor of the trade, technically I took double the size of the trade, and half I booked profit already. So I'm holding the remaining position. The cluster of patterns helped me size it with a bit more confidence. Now, do I suggest that? And I do not suggest that for novice traders, and I do not suggest that for traders who don't have a net profit in their trading account. Once you have a net profit in your trading account and you are used to a particular trading system and technique, then when you see confluence of signals favoring the trade, you may increase the size accordingly, according to your risk tolerance. And to be perfectly clear, in the early days, I was very hesitant in fact, to change sizing. I used to take same risk in all swing trades. The more mature I become and the more account profit I accumulate, I am willing to change sizing depending on how much more confidence I have the trade. Probably it comes only with more and more practice, more and more maturity, and more trading account profit. So I don't suggest changing sizing for people who don't have a net account profit, because then any loss in the larger sized position will take longer to recover. Not easy to do for a losing account. For a profitable account, it is easier to handle psychologically. That was my trade this week. As you can see, looking at weekly daily, it is still at a lower price level. If the market indeed pulls back, it is overbought now. If it indeed pulls back, then defensive stocks may do better. Doesn't mean they will shoot to the sky, but they relatively may do better, and GIS is a defensive consumer staple stock. If you carry out 360 degrees analysis using Q like that, you may most likely find other trading candidates today just as you would almost every other day. Let me end today's session here. Thanks a lot for joining. I look forward to seeing you in my next session. Have a great weekend, and as I always say, as these live examples, I'm quite confident shows there is no reason not to do that. Trade profitably. Thank you.